So we're delighted to have Paul Merriman joining us this morning. Our session is being recorded. In addition, Paul's presentation will be available after his talk on our website next week, along with a video recording. And for all of our listeners, viewers this morning, there is a Q&A feature. Please go ahead and ask your questions during Paul's talk. Jeff and Evan and I will be asking Paul your questions at the conclusion of Paul's talk. And now it gives me great pleasure to welcome back Paul Merriman. As the bear market continues, the title of Paul's talk today is incredibly timely. The inside story of 150 portfolios better than yours. Paul's talk today will compare a range of returns from portfolios originating from various sources, including Vanguard, Betterment, and many others, examining long-term returns of these portfolio combinations, which range from less than 10% to more than 14% a year. The talk will review the risk and rewards of these portfolios, dive deeper into 6 risk measurements that can help investors select the portfolio best for them. A little bit about Paul. He's nationally recognized expert on mutual funds, and indexing and buy and hold strategies. And he sat in and heard a lot of Dan's talk, so I hope he'll ad lib a little bit and talk about buy and hold vis-a-vis what Dan was talking about during his talk. Paul is the founder of Merriman Wealth Management, an investment advisory firm. Since retiring from managing that firm, he's now dedicated to educating investors, and in 2012 launched the Merriman Financial Educational Foundation. He is the author of 8 different books, including We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. Paul is also a contributing editor to the AAII Journal, and in 2021 received the James Clinton Excellence in Investment Education Award. Okay, Paul, go ahead and share your screen.
All right.
And we welcome you, and we're delighted that you're joining us this morning.
Thank you, Fred. And I will tell you that I really found Dan's presentation absolutely amazing, because it's this challenge as a discussion about buy and hold this morning. Let me get this full up here.
Okay.
That should do it. The challenge is because Dan makes absolutely perfect sense. And one of the challenges I've had over a lifetime of investing, going back to the mid-60s, is that there's always list A, the good news, and list B, the bad news. And the fact is that if you want to be a bear, you go to the good news. If you want to be a bull, you go to the good news. If you want to be a bear, you go to the bad news. And if you talk like a bull, but you're bearish, people are confused and don't know what you believe in. As a matter of fact, I used to do a 3-hour presentation in the morning about buy and hold, and a 3-hour presentation in the afternoon about market timing. And we found that people walked out of there asking, what does this guy believe? Well, the reality is, because today, from me, is going to be buy and hold, not market timing. But the reality is, from my experience, probably 1% of investors are going to make the whole process of market timing successful on their own. But I do believe that 95% of investors could probably make buy and hold work for the long term, because market timing is by far the most complex, most psychologically difficult strategy that an investor can use. Buy and hold, if you really believe in it, is the easiest of all. Because a buy and holder, all they have to do is to know about the past and make some commitment to exposure to risk and exposure to defense. In other words, how to protect and how to take advantage of bull markets and protect against bear. You can do that with a certain amount of stocks and bonds without having to be a timer. So what I'm going to talk about today is the information that we provide as a nonprofit to help investors have tools and information that would allow them to act as a professional investment advisor. Because when you are a do-it-yourself investor, in fact, you're working for yourself. You are the client and you are the advisor. We want you to have the information that I used as an advisor. And let me get this thing moving forward here. And I'm going to light up this pen so I have access to it. Our work is focused on 7 different areas. I'll talk about several of them today. About selecting the best equity asset classes, those that you should, as a buy and holder, consider to be in your portfolio. And then how much, given that there's a list of equity asset classes that have been identified, how much in each one. I'll show you some ways to make that determination. And then how much in equities and fixed income, because that is the way a buy and holder is going to control the exposure in terms of losses in a bear market, is how much in fixed income, which of course, as Dan points out, and we all know, recently the problem with bonds has been they look more like stocks these days in a bear market than they do like bonds, and how to deal with that. And I'll give you some perspective on that. But I will briefly talk about the equities and fixed income, briefly talk about distributions using these portfolios that that we'll be exploring. And I'm not going to be talking about how we select the ETFs. If you want to know how we get our best in class ETFs, I hope someday you'll hear from Chris Pedersen. This whole idea of 150 portfolios better than yours came from Jim Dolly, who runs the White Coat Investor. And it turned out that he wrote an article in 2014. We've got a link here. And by the way, Fred will have to talk about how they get the link to the PDF that I sent to you, but that will be something that we'll have to mention so they can all have access to it. But this article listed 150 different portfolios that were created by Vanguard and the Coffee House Investor and all of these Couch Potato, Ferry, Swedrow, etc. And the idea was that if you just followed any one of these portfolios, you would have a portfolio that would probably produce a better return than the one you might do on your own. And so that was the premise, and he has continued to upgrade that list. He now has over 200 portfolios, and we have a link to those 150 plus portfolios, as well as a link to the returns of a sampling of those, so you can see the range of returns you would historically have gotten going back to 1970. And a slight correction, Fred, because we did some recent new research, I have chosen to take what time I can, rather than showing these old portfolios, to show some new information that I think is some of the best long-term return information that I've ever seen in helping people make a decision about their choice of portfolio. We'll get to that. And by the way, there's one more. Einstein Portfolios will have, there's a link here to that website. They have 235 of these kind of traditional portfolios, plus they show performance so that you have a chance to compare the performance. And there is no cost to most of that work. In order to look at equity returns, because as a buy and holder, you got to make the decisions. What asset classes am I going to put in my portfolio? Well, we have the good fortune of being able to take work that's been done by the academic community to track back to 1928, the year-by-year performance of the S&P 500, which of course is, although it's considered large cap blend, it really is a growth-driven index. And you can see here for the 94 years, the compound rate of return was 10.2%. Large cap value over that same period was about 1% higher. Now, it is interesting to note that if you look at the growth index, which again drives that S&P 500, largely. That PE ratio is about 30 right now, as opposed to the large cap value index at about 14. So there's a huge difference in the kinds of companies and the kinds of following these companies get. And people consider large cap value to be more risky. That's one of the reasons it has a lower PE ratio. Then there's small cap blend, a third major equity asset class with a 12.1% compound rate of return over that period, and small cap value with 13.4. So obviously, if we didn't have to worry about the downside, we'd rather have the 13.4 than the 10.2. But the reality is more people are comfortable with the companies that are in the S&P 500 and see it as a great deal less risky. I am going to challenge that thinking in a way when we look at not holding the small cap value by itself or a small cap blend, but combining these four equity asset classes in equal portions to give you historically a return that it isn't 13.4, but it is 11.9 versus the 10.2. That is over a lifetime. I don't care if it's your retirement lifetime or as a beginning investor, that difference is huge in terms of compounding. It looks very different when we look at the returns in 40-year periods. Because if we look at the average 40-year period, the S&P 500 has an 11% compound rate of return, large cap value 13.5, large cap blend about the same at 13.7, and small cap value at 16.2. Now, why did this return change so significantly? Because when you looked at those 40-year periods, the early period started in 1928, and of course then took in 29, 30, 31, through that 10-year period that the returns were terrible and they were going to impact 40 years. But as soon as you get past that approximately 10-year period, all of a sudden the average goes up considerably. And it is interesting to note that over the last 52 years, the S&P 500 has in fact compounded at 11. The small cap value has not compounded at 16.2, partly I suspect because more people know about it today. But notice the four fund strategy, 13.7% compound rate of return, almost a 4% improvement over the S&P 500. And we'll talk about these other combinations in a few minutes. I think this is one of the best learning tools that I've seen. Daryl Balls, who is our director of analytics, who has been working without cost, hundreds of hours a year, helping us educate folks. When I asked him if he could put together a table that would reflect the annual returns of these different asset classes, I didn't realize he was going to give us what they call a quilt chart. But I love it because we can take one glance, and if we know that the green boxes are the S&P 500, and we know the tan boxes are large cap value, and the pink small cap blend, and the electric blue small cap value, and what we'll call here the four fund combo, 25% each in each of those, you can quickly by eye see that the returns, good or bad, are immediately identifiable. You can see long periods of time where, like 1940 through 1945, the S&P 500 is exactly where it should be. Remember, historically, it produces the lowest return. So we would expect it would spend most of the years in that place. But there are lots of periods where the S&P 500 is up here in the top 51 to 53, and then we have recently 2014 through 19 here. You'll notice that the S&P 500 has been on top, at which point everybody seems to say small cap value is dead, large cap value is dead. It's now all about the S&P 500. Well, That's not likely true, but it is easy to see why people can get that feeling when they've seen something acting in a certain way for an extended period of time. When I listened to Dan this morning, I was thinking about this particular slide, because what I've done here is blow up 4 years in a row. And I can tell you, I have no idea, because my work doesn't really focus on what PE ratios were, whatever the kinds of things that Dan is looking so carefully at. We just want to know, how did these asset classes do in that year? Interestingly enough, you can see in 1997 that obviously value did better than the growth-based blend portfolios of the S&P 500 and small cap blend. Not a great difference, because they all did well. And of course, right there in the middle is the four fund strategy with a 35% rate of return that year. So I don't care why value did better. I just notice it's interesting that there seemed to be, for whatever reason, a focus on value. The next year, it's a focus on large. S&P 500 and large cap value do better by far than the small cap asset classes. I mean, while people were celebrating here in the S&P 500, I recall we had discussions about the death of small cap because it just wasn't performing anymore. Well, it did come under a lot of heat, but then of course the next year, here we have growth-oriented asset classes that did well versus the value. Those are around 21, 22, and the large and small value were around 8, followed by a year that small cap value was doing great, while the up 20%, while the S&P 500 was down 9. So my view is, as somebody who understands market timing and believes in trend following kinds of market timing, not predictions, that it is very difficult for people to know what is going to do best in each of these calendar years. Of course, there's nothing magic about calendar years, but it is the way we tend to look back. But once we go out 10 years and look at all the decades starting in 1930 through 2010 through 2019, it is quite easy to see that small cap value was at the head of the pack for most of those years. And S&P 500 had a lot of years where they way underperformed the market. As a matter of fact, the return for the S&P 500 in 2000 through 2009 was worse than the return from 1930 to 1939, and that does not include inflation, because there was actually deflation. So the S&P 500 actually did better in 30 to 39 than it did from 2000 to 2009. But I want you to notice something, because I don't think I'm going to convince this group everybody should put all their money in the equity part of their portfolio into the small cap value. I'll talk about that in a few minutes, who should do that. But I want you to notice right here, close to the top in most of those periods, was the 4-fund combo. In fact, in the 2 years the S&P 500 was in first place, the 4-fund combo was close enough to it that I don't think anybody would be upset that they underperformed. On the other hand, there were years for decades where, for example, here in 1970 to 79, the 4-fund combo is 10.6% compound rate of return versus 5.9 for the S&P 500. Well, what we're worried about is over a lifetime. And if we do look over this period as a lifetime, you can see that between the S&P 500 at 9.8 and the 4-fund combo, there's over a 2% compound rate of return difference. Again, every 0.5% is actually a life-changing event when we look at the long-term compounding, even if we looked at it during our years of retirement. And also this particular table shows you that bonds are where bonds should be, that most of the time bonds are going to be down there at the bottom of the stack because they have less risk. Now the question becomes, if we looked at these asset classes, and by the way, you'll notice that they don't include the internationals, but the same people who told us we should be looking at those four have also told us we should be looking at similar international equity asset classes. And so in the mid-90s, I developed this ultimate buy and hold strategy idea, only to introduce people to the concept of what happens when you add these other asset classes to an overall portfolio. And so quickly, you'll notice that the S&P 500 portfolio one, 100,000 grew to 23 million. If you took 10% and put it in large cap value, kept the other in the S&P 500, it went up 0.2%, or up to 25 million. Then if you added small cap blend, another 0.1%. Small cap value, that is the gold ring on a long-term basis in terms of asset classes. It adds 0.4%. Now you're up to 31.7, and then you add REITs, you're up to 32.7. Then you add the four international equity asset classes that mimic the large cap blend, the large cap value, the small cap blend, and the small cap value internationally. You're up to 40 million, and then with emerging markets added to the portfolio, it takes it up to 47 million. Notice this is rebalanced once a year. Compound rate of return for the portfolio, 12.6 versus 11. If you rebalanced monthly instead of annually, it's 12.3, but the volatility is lower. So in 2017, after adding a fellow named Chris Pedersen joined along with Daryl Balls, our research group, and they started saying, we've got to make this process simpler. This ultimate buy and hold portfolio, 10 different mutual funds or ETFs, too complex. At the same time, I had a fascinating meeting with John Bogle for 90 minutes. He criticized the same thing. He said, it's too complex. If you really want to help people do it themselves, make it simpler. So we went to work building portfolios that now anybody can have access to. If they want, they can use Chris Pedersen's recommended best in ETFs. I think he does an amazing job. But here is what Daryl Balls did for us, not only in looking at those representative samplings that you can access from that early slide from the 150 portfolio article, but these are the returns of these 9 strategies that I just laid out there, that we now have all this data, but we've done similar types of research with both series of portfolios. S&P 500. Under here, you have the compound annualized growth rate, not only for the whole period, but for the decades. So now you can compare that to any of these other portfolios, from the ultimate buy and hold to a worldwide 4 fund, a US 4 fund, a worldwide all value, US all value, all small cap worldwide, all US small cap value, and a 2-fund strategy that I just think is fascinating, that is half S&P 500 and half small cap value. And you'll see why it is fascinating. But notice this, you can look at these decades and see how different each one of these did. I mean, you had a high of 17.2 in the all small cap value to a low of 5.8 in the S&P 500. By the way, the return of the total market index is virtually the same. And you can see 2000 through 2009, the S&P 500 lost 1%. And again, the all small cap value up over 10, the all value worldwide up over 8, and the 4 fund US was up 4.8%. So about a 6% difference between that and the S&P 500, and they're both all US. But then Dahle broke up the positive years, the years that they made money, and he looked not only what the average loss was in the years they lost money, he also summed up all of those losses and said, in essence, this is the loss you would have been exposed to with the S&P 500 or the ultimate buy and hold. 787 for the S&P, 863 for the ultimate buy and hold, 875 for the worldwide 4 fund. And in fact, in one case, you get up here to over 1,000% accumulated losses. And interestingly enough, 872 here with the 2 fund. So now, excuse me, I said losses. I want to restate that. These are all the positive years, not the bad years. If I said bad years, I apologize. It's not easy being 78, let me tell you. Then what I'm noticing then is that some of the years show how well they did in total over those period of positive years. The next group represents the losing years. And you'll see the sum of the losses for the S&P 500 of 141. The sum of the losses for the ultimate buy and hold about the same, 137. If you go all the way over here to the 2 fund strategy, it's 130. In fact, there's really nothing that is very different between the S&P 500 and all the rest of these portfolios, with maybe the exception of the all small cap value. And then he also shows the standard deviation, Sharpe ratio, Sortino ratio. These are ways, and the one that we think probably is most meaningful is to look at the Sortino ratio, which you then can compare who did the best in the difficult periods, the losing periods, and compared to the return that they made. So this gives you the ability to really dig into each one of these strategies. In fact, if you wanted to, you could look at every year, not now, of course, for all of those strategies. But then he had an idea. Why don't we look at the decade returns starting in 1970 for all of these different strategies? Would we learn anything special there? Because the individual asset classes are different than the combination. And so it gives you an ability here to get a better appreciation for how these different strategies kind of move around. Now, you would expect that the S&P 500 would be down here towards the bottom of the bunch because they historically have the least risk. And you would expect that there'd be a time that other asset classes didn't do well, like from 90 to 99, small cap value was not a good place to be, although that was because the internationals didn't do well. The US did okay, as a matter of fact. But let me take it one step further, because this, I think, is the finest work that Dahle has done. Because what Dahle has provided us here is the ability to look at these strategies. Now, this is US only, because that's what we have the numbers for. We don't have the numbers for the international market going back to the 20s. But what we can see here, 1 year at a time, is how these different portfolios performed 1 year at a time. And you'll notice, for example, not a surprise, the S&P 500 as a standalone asset class is going to be at the bottom most of the time. And we would expect the small cap value to be at the top a lot of the time because it had the highest return. So what Dahle did to make it easy for us to understand the kind of the overall impact of that is he created a relationship to compare these four major strategies and look at them in terms of how often were they in the top quintile, in the second quintile, third, fourth quintile, and how often were they at the bottom of the pack. And it turns out that in 45 years, small cap value was at the top. It was rarely ever in between, only in 19% of the years, 18 years. But it was 31 years at the bottom. So as we would expect, something that has higher volatility is probably going to spend more time at the bottom. And it certainly did. But it spent very little time in the middle. When we go all the way to the bottom of the pile, remember I found the idea of two funds interesting. It turns out the story of the S&P 500 is virtually the same. We expect it to be at the bottom a lot of the time, maybe even most of the time, and it was 51% of the years. But when it wasn't at the bottom, it tended to be right at the top. So if you put these two portfolios, these two asset classes together, what you get is obviously a better return than the S&P 500. But look at the amount of time you spend at the top and the bottom, 0. In fact, you spend 100% of your time somewhere in the middle, which says to me that certainly the S&P 500 in my view would be more risky than the two fund strategy certainly over a longer period of time. But also notice what I'm sure that Warren Buffett would appreciate, the impact of the all value. Now, the all value is half in large value and half in small value. And so the compound rate of return was 12.5. And that's a nice improvement over the 12.2 of the two fund strategy. But notice it too spends most of its time, 74% of the time, in the middle, some at the edges, but most in the middle. So I would not be uncomfortable, particularly if a young person in the early years of investing. I'm a believer that young people should be all equities for at least up until their age 40, maybe even beyond that. But for a lot of that period, to be in small cap or a combination of small and large certainly has information to suggest that it would be a wise place to be. Now you'll notice the US 4-fund strategy still has a huge increase in return and barely spends any time in the first or fifth quintiles. It too is almost all of the time in the middle. And what we all struggle with, I think, is we like the returns when we look backwards. We know that we can't be guaranteed those returns. The question is, what is the ride likely to be like? How can we have a sense of confidence? And I think looking back at 94 years worth of data ought to give us a pretty doggone good look. And what we have done in order to help people figure out how to use these different strategies is what we have done is we have created fixed, what we call fine-tuning tables for the individual to investigate. Let's say that you believed in the S&P 500 and only the S&P 500. Well, then what do you need to know about it in terms of adding bonds? And by the way, the bonds that we have added here are all intermediate to short term, 20% in tips, 30% in short term, and 50% in intermediates historically. I might mention that when you look at the worst 6 months for that combination over the last 52 years, it's right about where we are now with the losses that have been sustained in that combination. So this table allows us to look at these different combinations of equity and fixed income. And to show it to you where you can actually see it, here is that same fine-tuning table, the bottom portion. We're trying to help the do-it-yourself investor get a good idea of the losses that a buy and hold investor is going to face. And for example, my wife and I are 50-50 stocks and bonds in the buy and hold portion of our portfolio. So we expect to have a 12-month period that we are going to be exposed to a loss of more than 20%. And we know that, and we're ready for that, so that we don't have to be panicking when it's down 10% or when it's down 15%, because we have agreed with ourselves that that is the risk exposure we are going to be as a buy and holder. Because the interesting part about what Dan has to say, I mean, it's fascinating information, but it means nothing to a buy and holder, except maybe you have a lot of anxiety when you hear that information, because you feel like, I should be a market timer and not deal with all of those risks. Well, I understand that feeling. Here, by the way, is the same table. And we have the same table for each of the 9 strategies that I talked about, where you can look at the combination, but the 100% equity is half S&P, half a small cap value. So that you can look again, when you have time at home, at the implications of different combinations of fixed income and equity. And of course, at the bottom of the page, here you've got what 100% equity made, what 10% equity made, and the risk and the standard deviation that went along with that. Of course, you can also look at the losses that went along with that too. But these tables are built to help you know what you're getting into with your portfolio. Now, if we look about, excuse me, I should leave that for you long enough to understand what it is. We're going to talk about accumulating money for young people, putting money aside towards retirement, hopefully for your grandchildren and your children, that this is something worth sharing with them. Because here we have the assumption that we look at those same 9 strategies, and what we do is we build a fine-tuning table, assuming you started with $83.33 a month, put away, in essence, $1,000 a year into the S&P 500, and every year you raise that amount by 3%. What would you have had at the end of that period of time? And what you would have had is about $3.7 million. On the other hand, if you were in the 50-50 S&P 500 and small cap value, you would have ended the period with about $6.5 million because of that extra rate of return. And to the extent that somebody just doesn't have the risk tolerance for 100% stocks, you can compare, if you wish, the 50-50 or 60-40. I mean, 60-40 ends up with about, looks like $2.7 million. If you were in the S&P 500, it was about $1.9 million. So you can compare these different strategies over a period of time. We can decide that the past has no meaning, or as Dan says, there is some rhyming that seems to go on. And over a long period of time, and this is the beauty of going back to 1928, and my hope is we're going to be able to build similar kinds of tables, results going back to 1928, as we have here going back to 1970, and I'll tell you how we're going to do it. Now, the question becomes often, because value and small cap value is such an important part of these better returns in those portfolios. Why is holding small cap value so difficult? Why isn't it easier? And here's the reason. Again, thanks to Dahle for this wonderful telltale chart. What he has tracked here is the relative return starting in 1927 of the S&P 500 to the small cap value. When that line's going down, that means that the small cap value is underperforming. It doesn't mean it's losing money necessarily, but it's underperforming the S&P 500. And it took literally, it took all of this period from 1927 here until about 47 or 40, I guess 45 or 46. It took all that time to finally break even with what the S&P 500 had done. And no sooner had it broken through than for 19 years, it produced about the same return. I mean, that's showing a lot of patience if you actually believed that that particular asset class was going to make more. Well, you didn't make more for all of those years, but then there was a burst of energy to the upside, and then a 7-year sideways movement, a burst to the upside, then a 17-year sideways movement, a burst to the upside, then a 16 plus years movement to the side. That is hard for people to take. We all want what we want when we want it. And when we think something is going to add value, the sooner the better. And I don't blame you for feeling that way. And then Dahle even broke it down into smaller pieces to show you how violent these moves could be. He shows, for example, the small cap value bull markets. And he shows over the start to end, a 13-month period, that the compound annualized growth rate was almost 59%. A 21-month period that it was 34%. An 81-year period, it was almost 19%, et cetera. So that you can see what we'll call the bull and bear markets, when a small cap value was underperforming and by large amounts, and outperforming by large amounts. At 78, I'm asking, should I have 25% of my portfolio in equity portfolio in small cap value? Well, I'm thinking that part of the portfolio isn't really about me. It's about, or my wife, it's about the people who will survive us. And here's what Dahle shows us, that when you look back to and track going back to 1927, 1 year at a time, small cap value outperformed the S&P 500 56% of the time. Well, at 78, maybe I've got 10, 15 years to live. That's okay, but not overwhelming. But if I go out 5 years, it was 65% of the time. If I go out 10, it's 77% of the time. If I can hang around for 15, there's an 86% chance that I will, at least looking backwards, that I will be ahead of the S&P 500. And by the time you get out to 20, which would certainly be anybody in their 20s would have that kind of a time horizon, the small cap value has outproduced in every 20-year period. We also have tables, and I think we have over 60 tables that are there to support the people in retirement. And what those tables show, we have two kinds: fixed distribution. The fixed distribution tables, what they do is they take an amount of the original investment, which was $1 million. They take out $30,000 a year. Every year they increase it by the CPI, the rate of inflation, consumer price index. It shows that for everything from 100% bonds to 100% stocks, those same 10% increments, with the S&P 500 being the asset class, so that you can see what would have happened over that period of time. Some periods of very high inflation, some obviously of very low inflation. And let me assure you, you'll be able to test this in any way you want. You'll be able to start this from 1970. You'll be able to start from 1980. I'll talk about that calculator that's available to you in just a few minutes. Then there's a table for 40,000. You think 30 and 40,000 makes a difference? Boy, does it ever. If you look down here, just for the sake of discussion, at the end of 52 years, 100% equity would have left you with $66 million for heirs, and you would have taken out the amount that here, about $6 million. That sounds like a little too much for heirs, but that's what the table says. If you just took another $10,000, instead of having $66 million, it's $11 million. So these tables show with small changes of equity and fixed income, with small changes of how much you take out, what a huge impact you can have. And if you want to talk about huge impact, look what happens if you get too aggressive and you take 50,000 or a 5% original amount out and you increase it by the CPI. You are moving in with your kids, if you want to look at it that way, if you live that long. And we do the same thing for the 4-fund strategy and the 2-fund strategy and all of those different portfolios. You'll be able to compare how they did. For example, instead of 66 million, it would have been 206 million, theoretically, okay? All right. And of course, here again, the 40,000 and the 50. Oh, notice here, the 50,000 in this particular case made it through the whole period. So it did have a significant advantage to the investor to have used the 4-fund rather than just the S&P 500. And then there's a thing called flexible distributions. Again, we have every one of these strategies mapped out for you to look at. And in this case, instead of adjusting the amount of distribution every year, you adjust the amount of distribution by a percentage of the ending value the previous year. So if you started with $1 million, your first distribution with a 3% distribution rate would be 30,000. If the value of that portfolio goes up, you get 3% of a higher number, as it did here in 1971. And the reason an investor could do this, totally ignore inflation, is if you have retired with more than enough that you don't even have to worry about inflation, then you have the ability to bob and weave, if you will, as the market goes up and down. And I'll tell you, it makes a huge difference. And let me show you where in particular. Let me go fast forward here to the S&P 500 with a 5% flexible distribution instead of the original 5% where you had to raise it every year for inflation. Instead of running out of money as you did in the mid-90s, all of these rows go to the bottom of the page. It's the same exact a combination of stocks and bonds. Everything is the same except your discipline of how you take the money out. And just being willing to cut your costs after a bad year in the market and raising it after a good year in the market, that is one of the biggest defensive moves that you can make, because it does make the money last longer. I did mention that we do have a calculator. I must have been a little over a year ago. A young fellow who had come to our site, Craig Apple, he had come to our site by chance, and it really was a random event, to learn how to be an investor. And he was working someplace where he was going to have money to put aside for the future. And so he used all of our database and build a program so he could test it inside and out. He could change how much he might take out by any fraction that he wanted to take out. He could put in any amount of money he wanted. He could, using our database, our strategies, our portfolios, he could test them over different time periods. And he did the nicest thing you can imagine. He came to our firm and said, "Would you like to have this to use it for the people who follow your work?" and it has been absolutely, people who have used it have given it rave reviews. You got to want to use a calculator to do it. But those people who like calculators, I think, will really appreciate the work that Craig has done, because all of these tables can be tested with your assumptions, not ours. You got kids graduating from college about now, and maybe kids or grandkids. And I hope you'll consider first reading this book. It is free. All you have to do is there's a link here that could take you right to our site. You can get a PDF copy of it. You can go to Amazon and get a copy if you want, but it is free. And the reason I want you to do the free one is because if you read it and you see that the information would be helpful to a young investor, I want you to send it, that PDF, to as many people as you know that might be willing to dig deep into it. It talks about 12 decisions. They're going to make them by design or by default. Every one of them worth over potentially $1 million. I'd like them to take the right one. By the way, for what it's worth, I would not encourage them to be market timers. The book really is all about buy and hold. Again, as I said earlier, I do not think that market timing is something that amateurs do well. Then there's another book. I'm sorry, it's not free, but all of the royalties that come from that book come to our foundation. It is written by Chris Pedersen. And Chris Pedersen is the one who has created the best-in-class ETFs that we provide. And he's the one who came up with the concept of combining small cap value with a target date fund. And it's a 2-fund for life strategy that I think is one of the most clever strategies in terms of simplicity and doing the right thing at the right time in terms of taking risk. And we have our website, but the most important things on our website, and I want to point these out because each of these links, and you have those links either here or in the PDF, takes you to a page where we have done a podcast and a written article, and we have all the tables there for people to dig into, for the ultimate buy and hold, for those portfolios, 150 portfolios, for the fine tuning tables, and all that I've talked about here on this presentation, as well as the ETF recommendations. Now, I think I'm about right on the time, Fred, so I am ready to take some questions.
Okay, all right. Let's see. So I was just on paulmerriman.com, and you can also just download your book if you go to the website, right?
That's right. And that's where the link takes you.
Okay, great. So
Yeah,
if you don't have the, because we will have Paul's presentation posted to our website sometime next week. And then, but if you have any trouble clicking that link, just go to paulmerriman.com. And I was just on it, and there's all this great information that Paul just chatted about. Okay, so Evan and Jeff, if you want to join us, that would be great. And then I will lead us off with we've got some questions here from our listeners, viewers. And I'll start with a question that Richard Krause asked. Does anyone collect data for rolling? And by the way, I can't believe the amount of data that you just shared with us, Paul. I'm blown away. So many different ways to look at this data over such a long time period. I mean, wow, talk about number crunching.
Well, but what our hope is, we'll be able to go back to 1928. And I think that'll help.
And I noticed that the worst drawdown for a 70 or for a 100% stock portfolio was like 50 from top to bottom was like 50. And that's exactly what Dan is predicting at the wide range from 30 to 50. So if he's true, it's going to match the worst drawdown in history if we hit 50.
Well, some of those strategies depends. If you look carefully, some of them are down as much as 58%.
Okay.
The biggest drawdown. So, and by the way, Dan mentioned the NASDAQ, the tech index being down almost 80% in the 2000 through 2002 bear market. In fact, and one of the reasons I want to go back to 1928 is so that people find out what happened, for example, to small cap value, the S&P 500. These indexes went down over 70% to as much as 93%. So, how much honesty do we need to help us make decisions? The thing is, obviously, for a young investor, I want them to be investing during a bear market as aggressively as they possibly can, but I don't want them in cryptocurrency, and I don't want them in an individual stock. Now, obviously, Dan would like his kids to be ready to buy a stock. I would like my kids to be buying small cap value. But, that's the difference in belief systems.
Okay. Here's a question from Richard Krause, and then I'll let Evan ask the second question. Does anyone collect data for rolling 12-month periods instead of calendar years to capture many more periods along with seasonal variations? Kind of a tough question.
Actually, on that table, what you're seeing at the bottom of those fine-tuning tables, the worst 3 months, the worst 6 months, the worst 12 months, the worst 3 years, the worst 5 years, actually 36 months and 50 months. Those are rolling periods starting every month. Now, that's an interesting piece of information because remember, I showed you in the ultimate buy and hold table a difference between looking at annual rebalancing and monthly rebalancing. So all of those returns in the fine-tuning tables are based on monthly rebalancing because we wanted to see that sequence of return impact. And so those actually probably understate what an average investor is going to do, because I don't recommend that people rebalance every month. As a matter of fact, I think one of the projects that Dahle has in his list is to look at rebalancing every 18 months. As a matter of fact, we're going to do an article about, well, what if you never rebalance at all? That is a legitimate thing to do. Mm-hmm. Never rebalance. When I came into the industry, what we were told to tell our clients back in the mid-60s is all they needed were 10 to 20 stocks. That's all the diversification that one needed. And they should buy great companies. And in fact, Dan mentioned the Nifty 50. I suspect some of those companies were the great companies that people were buying and putting away in a lockbox. And they weren't supposed to take them out of the lockbox until they reached retirement. And the only reason to take them out of the lockbox was to go cash in to meet your cost of living in retirement. Well, that's no rebalancing for a lifetime. And so that was actually what people were supposed to do back in the mid-60s. But what I'm recommending to these young people with small cap value for the first 5 years of their life in terms of an investing life is you only have to pile on with that money, that first 5 years, $6,000 a year, and let it go, never sell it, live off it in retirement, and the total return with a 12% compound rate of return, there's the what if, is about $50 million.
Wow.
So there is a time when rebalancing may not be the right thing to do.
Right. Okay, Evan, you got a question?
Oh, yes. Somebody asked about using the data and the charts to design a retirement glide path. And that brings a larger question to me. What do we say to people that are 2 or 3, 4 years from retirement? They've been pretty aggressive for the last 4 or 5 years, and that's worked really well. And now they're looking at a 401k or an IRA that's down 20%, going, oh my God, what am I going to do?
Well, that's an interesting decision. When I was an investment advisor, And I got a hold of people who were 5 or fewer years away from retirement, and they had enough money already, which many people do. They just haven't reached the point. I would ask them whether they should still be invested so aggressively, or should they start winding down that exposure to risk now? See, a glide path makes sense, but a glide path at retirement, if you look at the glide path that Vanguard recommends, or Fidelity recommends, or BlackRock recommends, there isn't much change. They're going to go from about maybe 60 or 70% equities, and by the time you're out 10 or 15 years, they've got you probably with 40 to 50% or 30% in equities. And what you can do with the calculator, if they want to use it, you can build your own glide path using the calculator. Now, it takes a little bit of time to do that because we don't have it at this point set up where you can say, I want to add every year 5% more in fixed income. You actually have to go in and set those parameters, but it can be done. The question is, what glide path would you use? The Vanguard glide path, BlackRock, T. Rowe Price, they all have very subtle differences. And that's going to depend on what kind of exposure to risk that you're willing to take. That's the point at which, if it ever makes sense to spend a couple of hours with a good hourly advisor, that it's worth sitting down and going through that discussion. Yeah, I don't think you have to hire them for a lifetime to understand what that conversion from a worker bee to a player bee, that you can figure that out. But those tables, if you look at them, you can see what the worst events are for a 50-50, for a 60-40, for a 70-30. And you can even see the impact of taking money out while you're going through those worst events. And that's one of the nice things about the calculator. You can start at different periods, so you can retire in essence right before a bear market and see what happens.
Yeah, one point, I don't know if you want to expand on this, that I discovered is you look at 4 or 5 different target date funds that all are the same target date, but the glide paths are very different.
Yeah, that's right. And actually, this is some work that Chris Pedersen has done in his book, and is doing online with us on our website as well. He's developed an average glide path, but that is a major focus of our work in the next couple of years, is working on the whole glide path decision, because in a way that's the last decision to be made. How do you know when to cool your jets and start adding bonds? I'm 78, I'm 50-50 stocks and bonds. I will never change. My goal is, because that's my risk tolerance. I want to make that extra money for children and charities, and not particularly to live on. So I want to stay committed. On the other hand, I'm just defensive enough. I don't want to sit there and have 100% equity portfolio go down 60%, which it can.
Okay, last question, then we can turn it over to Jeff or back to Fred, is how do you help people with the discipline to hold on? I mean, last year it was easy to hold on. This year, yes, I understand the numbers and I understand all of that. How do I stick to this? I'm going crazy. I can't sleep.
You know, I hate to sound like somebody trying to sell the services of an investment advisor. Anybody can be an investment advisor in a week if all they had to know was the stuff that's on those tables that I have. I used to use these kind of tables to work with people. It is holding hands during the tough times. Not only holding hands with the spouse who loves investing and who thought they were smart with what they did, and now they're emotionally stuck with what they've done and they don't know how to admit that maybe they made a mistake. but it's also that spouse who didn't show much interest before, and now all of a sudden when the portfolio is down, they have found interest at last. And you have to deal with people and help them through. That is what you pay an advisor for. So our work, the reason we have all of these tables is because I think the only way to stick to what you said you're willing to do is to see enough of the information to be able to say, yes, I expected that, and I was ready for that. I'm ready for it. I'm not going to panic. And I think that's because I know those numbers inside and out. I want other people not only to know them, but to believe they have some relevance. I mean, in a way, if you think what Dan did with us in his presentation, he took a lifetime of learning about all these different variables and how they work together. And then he quickly shows you what conclusions he comes from with that information. Well, it all sounds very quick and easy, but it isn't quick and easy at all. He had to understand all that stuff working together somehow. And so how would we ever expect a do-it-yourself investor to do that? But I still have the belief that a buy and holder who can understand what an asset class is, can understand the risk of that asset class, can understand the implications of combining it with other classes. Owning the S&P 500 was not diversification enough for 2000 through 2009, because the S&P 500 is one asset class, basically, large cap growth. That's what drives it. And so what we know, as I said earlier, diversification is more than just large cap growth. It's other small cap, even a little bit of small cap growth isn't horrible. And it's putting these portfolios together. 150, over 200 portfolios put together over at White Coat Investor, 235 at Portfolio, Einstein Portfolio, or whatever it's called. There's no shortage of legitimate strategies. There's shortage of knowledge of what the trip is going to be like with those strategies.
Okay, can I ask a question?
Yeah.
Sure, Jeff, you're up.
Okay, yeah, I enjoyed your talk, Paul, on the different asset classes. I've read some books and heard some people that within those asset classes, you should add commodities to it, because, you know, it's like it's the opposite. Commodities will do the opposite of what stocks will do. And especially in a high inflation environment, you should now be adding commodities. So what do you think about that?
Well, I mean, I think that may be a great market timing move. But if I'm talking about buy and hold,
yeah,
if there's going to be something in the portfolio that has risk in it, and we know that commodities have a lot of risk in them. They go down a lot sometimes.
Right.
And so when I look at the long-term performance and I look at the risk that the investor takes, I said, well, this looks like an equity asset class. Okay, if it is an equity asset class, what is the additional return from having that equity asset class in the portfolio forever? I mean, forever.
Right.
And I say, wait a minute, it doesn't help the return. In the case of REITs, you will see that it has a small difference in return, but it doesn't go up and down like the S&P 500. So you have some non-correlation, but you have an expected return as a business. But there is no expected return from commodities other than, in a way, like cryptocurrency has an expected return, or gold has an expected return. I would never consider gold a good long-term investment. It might be a great short-term speculation. It might be something that gives you a sense of protection, like many people feel about their house. Well, at least I don't have a mortgage, and at least I have a bundle of gold in the basement. By the way, I do not. But for people who are looking, it's not there. But I don't see it as an investment. I see it as a non-correlating asset class that can hurt you or it can help you. I don't want things that hurt me if I don't believe they're going to add a premium. We should never take a risk for which we do not receive a premium and expected premium, and we do not expect a premium with commodities.
Okay, I got one last question. So on the issue of bonds, you know, when you have low inflation, you've got a negative correlation between stocks and bonds, which is why a 60-40 portfolio has worked so well. So what Dan was saying in his talk, well, now that inflation is a lot more than 3%, the correlation's gone positive, and he's expecting, you know, bond prices to keep tanking along with stocks. So it's a 60-40 or 50-50 asset allocation between stocks and bonds. Does it still make sense?
Well, you know, the challenge we have is knowing at what point do we say something doesn't make sense. For example, after the S&P 500 from 2000 to 2009 compounded at a negative 1% year, and since 2000 has compounded at about 6% a year. Why are we keeping that asset in our portfolio? It's a lousy asset. For 22 years, it has only made 6%. That includes the dividend, by the way, reinvested. Well, if that's the case, what would the academics say? Well, I know there was a period of time that Dr. Fama, Eugene Fama, who identified, along with Dr. French, this work on the factors that are so popular today. But for 30 years, small cap blend underperformed the S&P 500, and he was challenged on that. And he said, obviously, it's not working. And his response to that was, well, you're not very patient, are you? I mean, that was after 30 years of underperformance. And by the way, it was almost like magic that premium came back. Yeah. And so I think because bonds, I've had people say, are you crazy? You're telling people to put money into bonds. Now, this goes back before the stock market had gone down as much as it has, okay? They were saying, you got to be nuts to be in bonds. They were sitting in stocks. And I was thinking, you got to be nuts to be sitting entirely in an asset class that is going to go down 50% at some point. And you're criticizing an asset class that is known for going down a little bit. Now, right now, the losses, and I think I may have mentioned this earlier, but the losses in the fixed income portfolio that we advocate for is down about the same as the worst 6 months over the last 52 years. So it's kind of doing what it's done before again. I would not give up my commitment to bonds because they haven't been doing well. Bonds, and again, it's because it's a buy and hold strategy. Okay. I can tell you in the part of my portfolio where it's being market timed, I'm not sitting on bonds because there was a strategy that said, went through the moving average or whatever, got to get out. Didn't know it was good. What happened, of course, because it's not a predictive thing. It just says, well, it's a change of trend. And sometimes that gets really ugly when that trend changes. And so I'm out. But that wasn't because I don't believe in bonds as a way to stabilize the portfolio, because I'm using bond funds to stabilize a part of my market timing portfolio. Why is my market timing portfolio 70% equity and 30% bonds? Because the standard deviation and the return of a 70% equity, 30% bonds is virtually the same as a 50-50 stock bond buy and hold. Except there's an exit strategy. And I don't care if it makes more money than the buy and hold strategy. It's there because I don't want to sit idly by and have a catastrophic event.
Okay, we've got two quick questions, and then we're going to close. Here's just a quick question on your tables. Are fund cost and fees baked into those return, on all the charts with all the data, have you taken into consideration the costs and fees in holding mutual funds and so forth?
In the 1970 through 2021, yes. That work that was done back to 1928, no, that is pure index.
Okay, so you're taking some kind of an average normative of a fee.
But here's the problem on that, Fred, and this is where, when you're trying to doing back testing, how do you be fair to the reader and not mislead that? So what we did was we said, okay, if we are going to apply fees to indexes, for example, where we don't have actively or passively managed funds, what fee should we apply? And so we've applied the fees, not assuming you can go to Fidelity and get 0 fee funds, but we've applied the index kinds of fees that we would see in those asset classes. So small cap value is being charged more than the S&P 500.
Okay, but the fees are going to be modest because they're index holdings. So they're going to be, 5 to 25 basis points, probably, something like that.
Yes.
Okay. And then let's see, here's an interesting question. If you were still back in your old business and you had one of your clients ask you, so Paul, where do you think the market is heading for the rest of this year and 2023? I mean, we heard what Dan said. Dan's pretty bearish through the end of next year. What would you say if you were in your old line of work and you had one of your top clients come to you and ask you that question?
It happened all the time. And the honest answer, I mean, the reality is they expect us to have an answer to that makes sense. Okay, if I want it to make sense, and I believe that there's always list A, the good news, and list B, the bad news, and the market's been going up, because I cannot predict the future. I can only say, the market's going up I will quote, if I wanted to quote something, I'd quote the good news. And if the market was going down, and then people will say, oh, that makes sense to me. Well, the problem is, I don't know anybody. When I look back at those year-to-year returns of those 4 asset classes going back to 1928, and I think of the job of trying to predict what's going to happen next, and the probability of anybody being very good at that, then I don't believe it.
Right.
I also believe that people have long periods of luck. When I met with John Bogle, he admitted that from 1976 to 1999 was one of the best times to have started an S&P 500 fund.
Yeah.
Remember, that was a fund that nobody wanted when it started. And it was only after it compounded at about 17% a year that people, whoa, this is where we ought to have all of our money. I told people, I can't know.
Yeah, no one knows, of course. No one knows. Dan Niles does not know we're going to be in a bear market till the end of it. He's professing, he's thinking that it very well could happen, but no one, of course, knows. So listen, I want to share with you one of the comments we got from one of our viewers. I think it's a great way to end this thing. Leland Warner writes, a huge thank you to Mr. Merriman for what was an epic amount of information. I rarely see groups trying to help younger people to get on the right investment path, and it is invaluable to have such a seasoned financial expert taking the time to share this information. With great appreciation.
Thank you. I appreciate that so much. That is what I get paid. That note is my income. It's called psychic income, and at my age, that's way more important than the money. Thank you. Thank you.
Well, thank you. And thank you for the great work your foundation is doing. And it's always delightful to have you join us, Paul.
Thanks. Thank you, Fred. Thanks to all of you. And good luck.
So, thank you. And with that, we will close this webinar down and invite everybody to join us next month. It should be a great program next month with Dr. Kotlikoff from Boston University. And then we've got the woman from the Crossmark Global Investments, Ms. Fernandez. So with that, everybody have a great weekend, and thanks for joining us this morning. Paul, thank you very, very much.
Thanks, Paul.
Bye-bye, everybody.
Okay, bye.